Global tax platforms provide tax professionals faster access to data and drive better insight based decisions from predictive analytics. It also helps improve capability to manage significant volumes of data handled within the tax reporting domain. Good morning, good afternoon, and good evening, ladies and gentlemen. Welcome back to my channel. I'm Anish, and in this video, we'll see how platforms are providing organizations with a seamless experience no matter where they have their tax reporting obligations. Tax transformation has become necessary because business itself is changing. Geopolitical landscape is evolving together with general tax and legislative changes. So, as a perfect storm relief, the tax function needs to be able to change along with the business. There is more and more reporting obligations, more and more demand from various parts of both the business and external stakeholders for insights and information, and digital tax transformation is all about being able to provide that information in an efficient and quick way, but not by increasing headcount or by blowing out the budget. So, let's first check out a brief historical background of tax transformation, how and when it all started. So, what was happening was that companies could move mobile and highly valuable intangibles to low tax states and then charge high royalty rates from related parts of the company out of high tax states to be paid into lower tax jurisdictions. From the group perspective, the income of the company didn't change, but taxes got saved. In a world where countries have different tax rates, a taxpayer can choose where in the world it wants to declare its income, and in a way can plan its tax rate. Let's understand this by way of an example. Ireland defined corporate residence to be where a company was managed and controlled. On the other hand, the US interpreted it to be where a company was incorporated. So, with companies incorporated in Ireland and managed and controlled in the US, stateless companies came into existence, paying no tax on their worldwide income. This problem was identified by OECD as the ability of a company to have significant digital presence in the economy of another company, in the economy of another country, without being liable to tax due to the lack of nexus under current international rules. That's P problem, permanent establishment problem. This was in turn a result of real concerns that states would lose investments to other less strict states. So, tax competition drove headline corporate taxes down. So, by deliberately making tax avoidance strategies available to their corporations that were unavailable to other countries' corporations, states got much needed competitive advantage to attract investments. Moreover, tax havens refused to cooperate as they had nothing to gain from cooperation, as high tax rates meant lesser investments and ultimately lower revenues. Combating tax avoidance also didn't justify ceding any part of a state's tax sovereignty to a supranational entity. So, as the states devised effective strategies for combating corporate tax avoidance, tax administration and tax authorities increased sophistication and development in automated technologies, thereby in turn requiring tax function of corporates are able to answer questions from tax authorities. Tax function knows the issues, knows the numbers, and is able to provide accurate and real-time responses. Infusion of tech into every aspect of our lives has ushered in an entirely new age of transparency. Tax leaders predict that revenue authorities will have even more direct access to their systems in future. So, something has to be done about this changing environment. Our Honorable Finance Minister Nirmala Sitharaman recently underlined the significance of tech transformation by saying that was the main reason behind ensuring good governance in India. So, with digital tax governance, we can clearly see how tech and governance go hand in hand. With the implementation of faceless assessments and appeals, it becomes imperative for organizations to be proactively ready with tax data and information. Currently, most tax functions maintain tax status on spreadsheets and documents. There are minimal insights available to tax and finance leaders on a day-to-day basis. For instance, pending tax refunds. To deal with this, organizations can implement a digital tax compliance and litigation tracker. It provides tax and finance leaders visibility over important areas such as tax and litigation status, tax refunds, tax losses, adequacy of tax provisions. With smart alerts, tax leaders can have full control over upcoming deadlines and hearings. Effective ERP systems are fairly advanced in dealing with taxes at transactional level. It counts the transactions and gives you an input for jurisdiction, rates and other information. You then, with just one click, create a report that you need to file. Strong ERP systems with advances in digital filing is a big leap in tax controversy and dispute resolution. With tax analytics, tax authorities are now able to reconcile and scrutinize tax data across the supply chain and also across direct and indirect taxes. Tax analytics help tax and finance leaders to proactively identify inaccuracies, inconsistencies and leakages at transactional level and improve tax processes by acting on such data insights. Technologies which facilitate 26AS reconciliation for TDS and TCS can also greatly help digitalize the entire tax processes through enabled dashboards which report potential tax leakages due to erroneous TDS, TCS entries by customers and suppliers respectively. So with this, ladies and gentlemen, we come to the end of this video. Thanks for watching and do let me know what you think of this video in the comment section below, and please don't forget to hit a like, share and subscribe. Goodbye, see you soon and wish you a very happy Diwali.